In this video, we're going to explain how to use proper risk management to correctly determine the lot size for your Forex trades. We're going to do this using two popular pip calculators that are online and free to use. After watching this video, you'll have a better understanding of how to correctly size your positions to prevent putting your capital at risk. My name's Damo, and before we get started, you're going to want to grab a notepad. Risk management. It's one of the most important things that we do as we're traders. Ensuring that 2% or less of risk of your account, like 2% of your account only is risked in one trade, will be a key factor in the preservation of your capital. We want to keep as much capital as possible, so we don't want to give it away. There's no reason for us to give money away into the market. What we have to do is we have to be, careful. We want to make sure that we're only risking 2% out of our account. Just to show you the reasons for this, right? So this is, you start with $1,000 and you lost 10 trades with 2% risk, you'd only be down 17%. You're at 83% of your capital still there. If you were risking up to 10% of your account, 10 trades, you're under 40%. That's a loss. That's huge. That's bad. We don't want to see that at all, right? Even with 5% risk, that's a big, you're down to 63%. You're almost half of your account gone if you lost 10 in a row. Like, it erodes away at your account quickly. And just to put this in perspective, gains that you require to get back to even, if you lose 10%, you need 11% to get back to break even, right? If you lose 40% of your account, you got to get 67% back. That means you have to grow 67% to get there. It's even worse when you hit half of your account. When you lose half of your account, you got to do double that work to get it back. So, it doesn't take much long time before you're ruined. It's super important that, you've got good risk to reward ratio. And a good risk to reward ratio is 1 to 2 or better. If you look at this here, you can see that a 1 to 2 risk to reward, that's not so bad, right? You'd think, if I'm only winning trades half of the time, right? How can I be profitable? Well, you can be profitable being half of the time if you risk 1 to 2%, right? So that means if you risk $10 to win $20 and you're on a 50% win rate, as you can see here, you're profitable after 10 trades. You're up $50 by the end of it. There's many different position size calculators on the internet. I've put 2 of them up here. Both links will be in the description, but I'm going to go over the MyFX book Forex calculator position first. That's the one that I use, and I find it the easier one to use because of a couple things I'll show you. So step 1, before we get into a trade, we need to figure some things out. What pair are we trading? We're going to do a sample of a Euro USD trade. You'll need to know what the current price of the pair is. You'll need to know how big your stop loss is going to be in pips. Is it going to be a 20 pip, 30 pip? You need to find that out. And what's the risk percentage for your trade? I'm going to be doing a 2% risk on my trades. That's what I prefer. You could do 3%. It's a little more risky, but 2% is where I sit. I think that's a good one to be at. Lots of people seem to fall with that. So let's go over to the charts. So I'll just show you quickly how to set that up. You just select long position because we're doing a buy. We're not doing a sell, which would be a short. Drop it on the chart. I figure that it's going to trade up and break this high here, and I'm not going to let it go below the low here. 35.7 pips. Okay, so this one happens to have a pretty good risk reward ratio. It's got a 5.4 to 1. So that means 5 times as much profit as would be my loss on this trade. So I'm going to go over to my position size calculator, and I'm going to select Euro USD. My account value, well, my account is US dollars. If it was in Canadian dollars, you put CAD. If it was Australian, you'd select Australian dollars. And it's going to calculate your risk accordingly. So I'm going to set mine back to US dollars. My account size right now has $2,000 of equity. Always use the equity number in here. Very important to use the equity number in here. If you have, $500 of drawdown, then you would be showing $1,500 of equity. That's the number you use here. This is very key because that other money's already tied up. You don't want to be including that, otherwise you will put yourself in a far riskier situation, or as some of us like to say, over leverage. You're going to enter in your risk ratio. It's 2% is what I'm using, and I'm going to put my stop loss in was 35.7. Okay. Now it says contract size here. This is kind of key, and I'm going to show you why. So we're going to flip over to my broker, okay? And I'm going to go to Market Watch. This is an MT4. I'm going to go to Market Watch, and I'm going to right-click Specification. Now, 90% of all of these things are going, all these Forex pairs are going to be traded with a contract size of 100,000. Okay. Now, the reason why I say to do this is because if you go down to, let's say, gold here, or sorry, not gold, this is silver, XAG USD is silver. Its specification, contract size is 5,000. So it's going to change the way that your risk is calculated. So be aware of that. Indices will also be different. Indices are even more so. This particular broker I'm using here is a contract size of 1. I also have brokers that are contract size of 100 for that. And you'll see that because some of them will have a minimum lot size of 0.01, while some of them will be a full lot. So that's where you got to sort of figure that calculation out. You got to go in there, and that's the number that you're going to enter in when you go over to your MyFX book, okay? Or whatever the position calculator that you're using. I'll show you how to do it with indices, but we're going to stick right now. We're going to hit calculate here now for our Euro USD. You're going to hit calculate, boom. You're going to see how many lots you need to put in. You don't need to worry about whether it's a standard, a micro, or mini here, because we've determined that with this contract size. So where it says contract size here of 100,000, that's going to determine your mini, standard, or micro lot. So when we hit the calculate here, it's going to show up here at 0.112. So that means in my broker, when I flip over to my broker now, okay, that when I hit my new order, and you're going to see here in this volume box, we're going to put in 0.11. Now we can't put 112 in because that's not a valid trade. It's not going to let me do it because it's just too many digits, right? Like if I now hit this and I go buy market, oh, hey, what do you know? It's successful. Let me do it. But it's only entered in as 0.001. So, let me just open that up there. That's going to be terminal. Yeah, see, so the lot size is 0.01. It's going to round it for me. So there you go. So that's how we figure out our risk on that, right? So now I'm going to have to go in and I'm going to have to put in my stop loss based off of the information I had on the other side. So if we go back over to Trading View and I go and I take a look at what my numbers were going to be, I would then enter those numbers in. So I would go on here, I go, okay, I've put my stop loss here, so I need to go back to my trading chart. So back to the broker. So there's the wick, right? So I'm gonna drag my stop loss just down below there, okay? So once it's set, okay, then I know what my stop loss is. I'm gonna hit the okay button there. Pretty simple. So let's go back over to a position size calculator. And let's just go through things again. You have a currency pair needs to get selected, your account currency, your lots, your account size, which is equity. Always remember to show your equity in there, your percentage of risk, and the stop loss that you're using for this trade, and then your contract size. So now I know I'm going to have some people ask me questions. Okay, well, hey, you know what? I'm trading US 30, or I like to do indices or gold. How do I do that? Well, metals are not a problem. Metals actually are in here. You can go select XAU USD for gold, and you're going to see its contract size is 100, right? So if we go back to the broker and we click on XAU USD and we go to specification to double check and make sure that our broker isn't doing things differently than what MyFX book does, you'll see the contract size here is 100. So now let's look at silver. See, it's 5,000. So let's go back over now to MyFX book and let's go see what happens here when we go and we pick the silver. So I'm going to go XAG for silver, and I'm going to pick USD, and look, they auto-populated. But what if I want to do an indice? Let's go US 30. Oh, there is no result found for US 30. So demo, what do? I have added in a risk calculator spreadsheet on here that you can use to determine that. So let's go have a look at this. So what I've got here, and I'm going to include the link to this Excel sheet so that you can have access to download it and you can use it as you like. If you were going to take a trade on US 30 and it was going to have a 45 pip stop loss, let's go have a look at what the contract size would be. So if we go to my broker and we go over here, let's close out this one. Let's go US 30, right click, specification, contract size of 1. Well, that's pretty nuts, eh? And a volume step of 1.0. So that means that it goes up $1 and down $1 when you're in that chart. So if I drag the chart over, it's going to move up and down $1 steps. Okay. If I have a contract size of 1 and I've got a $2,000 account, I'm risking $60. Look what happens if I try and put a 70 in. Because I have a contract size of 1, I can't take a position smaller than a 1 lot, right? Which is standard lot. So that means I can take up to a 60 pip stop loss. I can let it run 60 pips. That's when I'm going to lose my 3% on a trade. If my broker, if I want a 2% risk, what can I do? 45? Is that what it was? No. Can I do a 40 pip stop loss? Yeah, my maximum stop loss that I can take on a trade is 40 pips. Oh, demo, but I'm doing a hedging strategy. No problem. Hedging strategies, nothing wrong with them. A hedge is essentially a stop loss in some ways. The only difference is your hedge, you enter into the hedge at 42% of your $2,000, right? You've got a lot size of 1, so that $40 stop loss, or you hedge at $40, because the whole purpose of risk management and doing a 2% risk in a trade is that if you enter one trade, you're not going to lose more than 2% of your account. That's where you need to enter your hedge, because if you let a hedge, if you let it get too far apart, that money in that hedge is at risk. That's what you've risked. You basically put your money on the table and said, yep, I'm willing to risk $40 in this trade because I'm going to take 2% risk on this trade. 40 pips out, that's risking the proper amount in your account. If you think about that, it's a whole lot easier to win back a 40 pips worth of trades. It's a lot easier to work that hedge out. Let's say we were doing 150 pips before we were going to enter into our hedge. So if that's the case, I could only have a lot size of 27. Well, that's not going to work. So let's see what happens if I had a $3,000 account. Nope. Let's try 5,000. Nope. 6,000. Getting closer. Let's try 8,000. Look at that. You have to have almost an $8,000 account before you can risk $150 in stop loss. It's pretty crazy, right? If you had a broker that had 100 contract size, which there's some of them out there, then you could do that. You could risk $150 at a 0.01. But you can see, right? There's definitely, it's definitely a lot harder to do. So if you wanted to do proper risk management, risk management where you're actually risking 3%, if you're going to risk 3% of your account in a trade, that means that any one time you can't lose more than 3%. If it hits your stop loss, or if you're unable to get out of your hedge, then whatever your hedge was for, it needs to be a 3% of your account. You let that get bigger than 3% of your account, then you're not following proper risk management. All right, so now that you've entered your trade and you've got, the trade going, what do you do next? Well, you got to sit back and follow your rules for the trade. You went into this trade, you made a decision. You said, I'm going to risk 2% of my account because I believe that this hits all of my rules. I see that it's going to go between these two pivot points. I've decided that there's an institutional candle, and so I know it's going to go to this area. Perfect. You've checked off all of the confirmations on your rules list, and you've done proper risk management. You've entered the trade. What do you do next? Be confident in your entry and accept it as a 50% chance of winning. That's everything you gotta do. So step 3 out of this whole thing here now, go do something else. Go read, go to work, look for your next trade opportunity potentially. Watching your trade will be worse than watching a pot waiting for it to boil. Stay away from it. You made that choice. Do not move your stop loss. If you've made a stop loss decision, you're only gonna risk 2%. If it hits your stop loss, fine, let it go. We know that it hit the stop loss. It is what it is. 2%. Don't be like, oh, well, I think I need to do 3. No, you stay firm with your rules and keep your stop loss where it is. If it's another thing if you've hit the 50% retracement and you move your TP up and you go take some partials, absolutely have at it. Don't move it further away. You already made that commitment to yourself. It's an easy trap. Oh, if I just move it a little bit, it'll go and keep going. Well, you know what? The next time you need to account for the fact before you enter the trade that you're moving your stop loss, You write down on a note when you do your post-mortem on your trades, the ones that didn't go well. Did you have your stop loss too tight? Well, if your stop loss needs to be bigger, you need to know that before you enter the trade so you can enter with the appropriate lot size so you're not over leveraging yourself and putting more at risk in your account than you need to. Mindset is everything. The key to becoming a profitable trader is to be like a casino. You got to stack the odds in your favor. We talked about that when we went over the 1 to 2 risk reward ratio, the fact that you only have 2% risk in any one trade. Commit to taking your trades with 1 to 2 risk reward. Only risk 2% of the trading account in any one trade. Do these things and follow the rules for your trading strategy, and you will be good. If you guys are interested in joining a free top-down chart analysis session, I'm looking at working with some people together as a group, and just going through the charts, taking a look at how the market's moving in a general area. It's not a session to teach anybody how to trade. It's just a matter of bringing a bunch of minds together, taking a look at the charts, and seeing what we think might happen for the next week. If anybody's interested in that, put a comment down in there, and otherwise, give me a subscribe and a like if you guys thought this was valuable. And we look forward to seeing you next time.